All right, everyone. I'll get started. Good to have a good crowd out tonight. I'll be talking about a couple of different things. First of all, we're obviously going to touch very briefly on the tariffs. The purpose of the presentation today is not all about tariffs. It's actually more about the new Liberal minority government and what that means for you. Although there are some interactions between our good friend down south and, of course, what we're dealing with up here in Canada. So I do want to talk about what all of the changes for government and with the tariffs and whatnot mean for you, and as it relates to interest rates and also the real estate market in Canada. First thing I want to talk about, obviously, the tariffs do have a major impact on Canadians and even on people in the U.S. Canada is the largest trading partner to the U.S., and of course, for Canadians, the U.S. is by far the largest trading partner for us. And so there is a big impact to the whole tariff situation. And for Canadians specifically, one of the things that I've been looking at is which industries will be impacted the most by the tariff circumstances, and it's oil and gas extraction is the big one. And then you can see that metal manufacturing, coal, petroleum product manufacturing, a lot of the other manufacturing has a relatively small impact. One of the reasons I bring that up is as we talk about the impact to real estate in Canada, also when you start to think about too, where are these industries and therefore which areas of Canada may be impacted more by these changes. For those of you that are in BC, for instance, I don't see a lot of things in Lewiston in British Columbia that are a large factor here, whereas I see a lot more that are in the prairies, so Alberta, Saskatchewan and Manitoba, and even in Ontario as well. Just in general, manufacturing, a lot of that is done in Ontario. And so, Yuri, I know that you had mentioned before we got started, who's moving out to Alberta. This is something that might be a factor, so something to think about. And yeah, Gordon, one of the things that obviously is a big factor is Canadian tourism to the U.S. I mean, anecdotally, I think a lot of people are canceling trips or not booking trips down to the U.S. And so I think that the U.S. is going to have a fairly large wake-up call, especially for those areas that are attracting a lot of Canadians. Be interesting to see on the flip side of that if U.S. residents don't come up to Canada as much because of the tariff war. I don't know if they really care as much about the whole tariff situation, whereas for Canadians, it seems like it's a really big deal. So I'm not sure if that's going to slow down people coming up to Canada from the US, but it definitely seems to be slowing down people from Canada going down to the US. A couple of things to talk about as far as like facts with regards to the tariff situation. I was at a conference about a month ago, and one of the speakers there was the chief economist with TD, and she said that, if we had a 25% tariff, which now it's not as easy and simple because, of course, the tariffs are starting to get customized based on the industry and based on a couple of factors. But the highlight of it is that if there was, for instance, a 25% tariff, about 5 to 10% of that cost would get passed to consumers. And that's because along the supply chain, you're going to have a lot of different companies along that supply chain who are all going to eat up little bits and pieces of this and will eat up some of that cost. So not all of the cost is going to be passed to consumers. I actually just saw something today that one of the car manufacturers is bumping up their costs on a lot of their new vehicles by about $2,000 per vehicle. Sounds like a lot of money, but also when you look at the average price of a new vehicle being $40,000 or $50,000, we're talking about a 5% approximately increase in costs. So we'll have to see exactly what this means. And of course, one of the issues is that tariffs are by nature inflationary, which means we don't know exactly where rates will head because of that. But of course, I do have some slides that will come where we'll talk a little bit more about what will happen with rates, because there's actually multiple things pulling rates in each direction, and it's very hard to predict which one will win out, whether rates will go up or go down. But I do have some feedback and some guidance for you, and a few slides on what some of the major banks and other people are predicting will happen. Now, one of the interesting things is that it's possible, especially if there's certain industries that are really, really affected by the tariffs and others that are not, We may see that the government, instead of dropping interest rates to help with this whole situation with tariffs, they might instead opt to specifically support those industries and those individuals that are affected by tariffs, and that would allow them to not have to lower interest rates as much to counterbalance tariffs. So that is something to consider, is that we might see government support instead of large interest rate cuts in Canada. And one of the things that's important too is that Canada in general is very sensitive to interest rates, meaning that it's sensitive to upwards and downwards. When interest rates went up, we started to spend a lot less, and the inflation got under control. Not extremely quickly, but relatively quickly. But on the flip side, if interest rates go down, you might see Canadians start to spend more, borrow more, etc., which starts to put some pressure upwards on inflation factors, which is also not good too. So there's a lot of moving parts here, and it's really difficult. It'll be interesting to see how the Bank of Canada navigates the situation coming up. And of course, inflation may rise soon. It is not necessarily immediate. There is some immediate factor where, for instance, yesterday I was talking to a friend of mine who works for a large electrical company, and they were talking about buying 10 bins of steel to get ahead of the curve, and buying a lot of product in a very short period of time, which has happened for a lot of companies, which has a short-term blip in inflation. On the flip side, a lot of the inflation really comes later on, because if it's going through the supply chain, it waits. It takes a while before it eventually gets to the end consumer who's purchasing the good. So again, there is likely to be inflation, but it might take 6, 12, or even 18 months before we really see the effects of that, as opposed to an immediate impact on the inflation side. And almost no doubt about it, it's highly likely that unemployment will rise, especially for those sectors that are affected the most. But there's also tertiary impacts. Even the industries that are not affected in a direct way are still going to see there's going to be some spin-off negative impact, and unemployment in general will rise, which of course is one of the reasons the Bank of Canada may want to cut rates in order to offset that impact. So something that the government, of course, has been watching very closely is inflation rates. Inflation was starting to get under control, in particular in Canada, but you can see in the U.S. not necessarily. And so, this is something that they're really trying to find a fine balance and walk a tightrope here, trying not to lower interest rates to the point that inflation starts to tick back up again, but also making sure that the unemployment rates are also in check, because one of the issues is in Canada, unemployment rates have been rising in the last 12 or 24 months. So that is definitely a concern for Canada, and it's not as much of a concern for the U.S. You can see the U.S. unemployment rate has been relatively low, at or below 4% for about 3 years now, whereas Canada got down to about 5%, but it's been creeping up to about 6.25%, almost 6.5%. So there is some level of concern that the tariff situation could push unemployment rates even higher in Canada. So the tariff situation, I think there's been a lot of discussion about that and the impacts of the tariffs. I wanted to talk a little bit more about the election and the impact, of course, of knowing that Mark Carney will be our prime minister, and the Liberal government will have a minority government, so they're not holding enough seats for majority government. A couple of stats and facts is that in the past, minority governments have only lasted 17 months on average, which I thought was actually really short. I thought this would have been much longer, but minority governments have not lasted very long. It's just very difficult to get anything passed through Parliament, which makes it very difficult for them to operate, which often makes them create majority governments by teaming up with another small minority. Interestingly, and this is news and interesting to me, is that minority governments generally have higher deficits. So as an example, let's say the Liberals are trying to pass a bill and they need some support from somebody. Well, let's say that they can get NDP support for the bill, but the NDP, of course, wants something. Well, usually, in order to give the NDP something, what has to happen is more money for the budget has to flow into the NDP or whatever their objective is. And so in general, in order to appease different parties to get bills passed in Congress, or not Congress, but in Parliament, you generally are going to have higher deficits because you're going to be borrowing more money to pander to other parties' needs. So I thought that was kind of interesting. Now, the spin-off effect of this, and how it's relevant for real estate and interest rates, if you have higher deficits, that means in order for the government to borrow money, what they're doing is they're issuing bonds. And if they're issuing more bonds, that pushes the bond yields down. And as we'll get to in a little bit, lower bond yields means lower fixed rate mortgages in Canada. So it's possible that with the minority government, we may see some downward effect on interest rates on the fixed rate side of things from this particular effect. In my opinion, I don't think that this is large enough to say, oh, fixed rates are definitely going to go down. I just think this is a small tertiary thing that will likely be a influence to push rates down and suppress them slightly, as opposed to them, all things being equal, being the same. And another interesting thought experiment as well is that Carney does take a relatively tough stance with Trump, and that could mean more Bank of Canada cuts, because if they're taking a tough stance and they say, nope, I'm here and you're here, and the tariffs are here to stay, and they get caught up in a fairly large battle, then we may be in a position where that large battle causes these tariffs and these escalating tariffs to continue, and that could cause, of course, larger unemployment on both sides of the border. Larger unemployment is more likely to cause the Bank of Canada to cut more. So, with all that information and stuff swirling around, what does that have to do with interest rates? Are interest rates projected to go up or go down? Is an interesting one. There's a lot of influences moving rates in each direction. This chart is a long-term trend of five-year yields, and it's interesting to note here. You can see if you look at the far right, that blue line all of a sudden spiked up and has been going up fairly recently, whereas the red line has been going down and stayed down. And this line right here is when this guy was elected. So there's a very large run up in the bond yields down in the U.S. So even though Canada is showing a lot of weakness, what's been happening is as the U.S. bond yields go up, it creates a bit of a floor underneath Canadian yields. Although we're showing more weakness, which should have caused our bond yields to go down further in that time period. At the same time, if the U.S. bond yields are going up, it buoys and kind of pulls our interest rates up with it to a certain extent. So realistically, independently, Canada's bond yields should be lower than they are right now, but they're not. And so if I look at a chart of what we've been dealing with for the 5-year bond yield, this is where we've been at. And the reason that we have this chart up and the reason that this matters is the 5-year fixed rates are very correlated with the 5-year bonds. And so money is lent out by banks to people like you and me. And then the bank is going to bundle up all of those mortgages, turn around, and they're going to sell them out the back door. And they call that a mortgage-backed security. It's what's caused the U.S. subprime crisis down back in 2008, when they bundle up mortgages and then they would call them AAA, but they actually weren't AAA. So it's the same mechanism, but it is a way of creating free-flowing money to ensure that people can get money and get mortgages relatively easily and cheaply. So what happens is if we see that the bond yield is going up, then that usually means that fixed rates are going up, because an investor can either buy a bond or they can buy a mortgage-backed security, and they're very similar asset classes. If bonds are going down, then usually fixed rates are going down. Now, some of the swings that you're looking at on this chart are very large. So you can see, around April 7th, give or take, there's a very large decrease that happened, and then followed by a very large increase. That swing was 0.5%. Is a very large swing. And so we actually did see fixed rates go up with a lot of lenders by about 0.15%, maybe up to 0.2%, depending on the situation during that swing. And what they'll do is they won't go down if the rates plummet like that. They'll wait until they stay steady. And so we didn't see lenders drop the rates a whole lot on the way down. And then when they went up and they stayed up, then interest rates went up a little bit. So we have seen some tweaks and some changes, of course, to fixed rate pricing. It's a little bit harder to get rates down to the 3.99 level at this moment, but overall, we're always following this bond chart to see what's happening to interest rates and where are they going. and there are big swings. There's a lot of volatility in a climate like this. So with all of that climate, volatility and all these moving parts, what are the predictions that the major banks are having? So I found this lovely chart that I like to follow, and this is giving everybody an idea of what the Bank of Canada, where the Bank of Canada is likely to go based on all of these major banks' predictions. So I'll give you an idea of what we're looking at here. So when it says current policy rate, that is the overnight lending rate. The overnight lending rate, then you add 2.2% to that, and that's the current prime rate. So the current prime rate is 4.95%. So really what we're trying to find here is what is the difference and what is the movement with regards to these adjustments and changes, and where do banks see the interest rates in June. And if you're looking at anything that's in brackets, that is the movement from the last estimation or update from the bank a few months ago. So in June, BMO, CIBC, National Bank all think that the Bank of Canada is going to cut 0.25%. Royal Bank and TD both think that the Bank of Canada will cut 0.5%, which is a pretty big cut. And then Scotiabank thinks that there won't be any change. And then in Q3, most lenders expect either an extra 0.25 point or staying the same in general. And then Q4, similar. But really, I like to look at the Q4 for 2025 and the Q4 for 2026. In Q4 2025, the banks are expecting, on average, they're between 2 to 2.25 for the interest rate. So it looks like we're kind of right on the edge of either 2 rate cuts for the Bank of Canada, so 0.5% further, or 3 cuts, so 0.75% lower. So anybody that's looking at a variable rate, either in one right now or considering a variable rate for the next mortgage, the current expectation is 0.5% to 0.75% cut by the end of the year. There's one weird outlier here, which is Scotiabank. They think there won't be any cuts, but then by the end of 2026, they think that the rates will go down by 0.75%. So they're expecting nothing, and then they think the damage will start to come into fruition in 2026, which would result in more cuts then. And so it'd be interesting to see, who's correct. Lots of projected movement here with regards to the Bank of Canada, but this is something that we follow quite a bit. The next one that I'm following quite often too is what's called a forecast curve, and so this is basically an aggregation of a number of different individuals and companies that predict professionally where things are going. So where the Bank of Canada is going, where fixed rates are going, et cetera. And so this is actually showing that the prime rate would come down 0.5% this year. But then in 2 years' time, it would go up 0.25%, stay there for a few years, and then slowly rise over time. And the bottom in blue, you can see that it's called a 4-year swap. I won't get super detailed into this, but a 4-year swap is basically a slightly more accurate mechanism of looking at where fixed rates are. So don't look at the actual rate, because that's the underlying cost for the bank. Effectively, you're very close to that. Really what you're looking at is what is the trend. And the trend is that in a year from now, they think that fixed rates would likely be up by about 0.1%. And then a year after that, they think another 0.2%. And so it looks like year after year, about 0.2% increases to fixed rates continuing. And so it makes it really tough to know, should you be going with a variable rate or a fixed rate? Because it's odd. You actually see that the variable rates could be cutting for the next few months at the same time that fixed rates might be slowly nudging up over time. And it makes it really difficult to make a decision, of course, on whether you should be going with a fixed rate or a variable rate, because, well, rates, if somebody asks you, are rates going up or going down? It's like, well, maybe both. So it makes it harder to make that decision. One of the things then to look at is, okay, we're comparing fixed rates and variable rates. Fixed looks like short term might be going down or flat. Long term, however, probably starting to tick up. And then for the Bank of Canada, prime rates probably decreasing 0.5%, and then maybe more. It really depends on the impact of this whole tariff situation and how damaging it is. We may see further cuts than 0.5%, but it seemed like almost every bank predicted at least 0.5% or more for Bank of Canada cuts. So with all that information, the really big question is, should you be in a variable rate? And that's, obviously a tough question to fully answer. It is kind of more of an independent type of conversation and more on a per customer basis. But one of the things we can see is that finally the variable rate pricing is now starting to get down to about the same as fixed rates, which has been quite some time. So if you look at the chart here, since middle of 2022, variable rates have been priced at a higher rate than fixed rates, and only recently in the last month or two are they finally about the same as a fixed rate mortgage. And so it's been quite some time for us to get back to that point. And if you look at the chart historically, of course, variable rates have been almost always priced at or lower than fixed rates. One of the important things to note about this is that when you look at bank spreads, so i.e. how much money they make on a variable rate versus a fixed rate, they actually take a smaller spread on variable rates than they take on fixed rates overall. So, that's one of the reasons that could potentially lean a little bit more towards a variable rate in a climate like that, just because if whatever product they're making a little bit less on is perhaps something where you're not paying as much for an insurance policy. So that's one thing to look at. And the second thing to look at too and consider is, this chart is showing variable discounts off of prime, and the fact that they're decreasing quite a bit. And so if we look at that chart, we can see that at the very far right, the discounts off of prime are getting worse. And that is something that we do see happen a lot during times of high volatility, like in COVID, subprime crisis, etc. Variable discounts went to prime plus 0. In fact, in the subprime crisis back in 2008, they actually went to prime plus 0.8%, which is very high. So if we see the variable rate discounts getting worse and compressing, that's often leading up to the Bank of Canada cutting interest rates. So if I just took a look at like a typical 5-year fixed rate with most banks for uninsurable mortgage, or a typical variable rate, you're in this kind of range. And yes, of course, many lenders or different clients are able to qualify for better interest rates, but this is just kind of like a typical advertised rate for a lender. We're seeing that a 5-year fix is about 4.44, and the variable is only about 4.55. So they're actually very close to each other. Now, so if you compare that, if they figure, okay, should it go variable or fixed? Well, and we know that the variable rate is likely to go down over the next few months, which would get you a rate much closer to about 4%, which is going to start to look better. But that rate also might start to climb later on in the future. So interestingly, when we do the math and compare a 5-year fix versus a 5-year variable, the interest cost is almost exactly the same over 5 years. So then the question becomes, well, are you in a position where if the rates do go up faster than expected, are you going to be able to afford it? That's obviously one factor, and that's one reason maybe not to go with the variable rate, to instead go with the fixed rate. Another factor is if you think that you might be breaking that mortgage early, then maybe consider a variable rate, because the penalty is 3 months interest instead of a fixed rate being 3 months interest, or something called an interest rate differential, whichever is greater, of course, it's banks. So these are things that to be considering, of course. And one last feature is the variable can be locked into a fixed at any time into whatever the fixed rates are at that time. Now, again, if you go back to that chart where fixed rates are supposed to increase over time, then the plan of going variable, waiting until the Bank of Canada cuts and then locking in, may not actually be a great option for you, because if fixed rates go up over time, then you'd be locking into a higher interest rate, not a lower interest rate. So Kevin, you're asking about comparing a 3-year fixed and a 4-year fixed versus variable. The variable outperforms the 3-year and the 4-year fixed, because the 3-year and 4-year fixed rates are similar to the 5-year fixed rates in today's climate. And so the 5-year fixed beats them because the 3-year fixed matures and comes up for renewal earlier, and then you'd be renewing at a higher rate once the 3 years or 4 years is up. So if you're going fixed, it's better to go longer if, in fact, the rates go up. And then the same applies for the variable. Although you'd be seeing a slow tick up, the fact that the fixed rate would have to renew in 3 or 4 years when rates are higher would result in more interest paid. So The 5-year fixed and the 5-year variable both outperform the shorter term fixed rates. And that is a new phenomenon, by the way, because for a long time, the 3-year fixed rate was the most commonly chosen term because it seemed to be the best value, a shorter term and a lower interest rate. And now we're starting to find that very few clients are actually taking 3 years. Most are actually taking 5 or going variable. I would say in general, my investor clients and clients that are more open to taking a bit more risk are going variable. And then my homeowners or first-time buyers are more likely to go fixed. And so it's about 50-50 in our office right now. And that's about how the math is lying too. I would say probably last September until January, February, a lot of our clients were going variable. And at the time, it made a bit more sense. And the pendulum was looking very pro-variable. And now with the tariff situation showing inflation being a factor in the future, which means that likely fixed rates or just rates in general will be a bit higher because of that, it's swinging a bit more towards right in the middle again. One of the things that's been coming up, and a question that we get asked a lot, is should you refinance? We've been finding that if you're with certain lenders, so some banks, when we do the analysis, the penalty exceeds the savings every time. And then with some banks, your savings would exceed your penalty. So we're working on a client right now where it's just a little bit underneath $1 million mortgage. The penalty versus the savings, there's about a net savings of approximately $12,000 to $14,000. And also the client feels more comfortable going into a new 5-year fixed instead of having only 2 years left on his 3-year fixed. So we're finding that a lot of clients are starting to opt into, maybe if we're at the low point or very close to it, maybe getting out of the 3-year fix that you took a year ago, especially if the savings exceeds the penalty, and being in a position now where you have a rate for 5 years instead of only for 2 more. We're finding a lot of clients are making that switch. So if you do want to learn more about that, just reach out to us and then we can do the math. We'll let you know what information we need. It doesn't make sense on every deal, by the way. It depends on the lender that you're with and, of course, what rate you can get on a new mortgage. But we can do those calculations and see if you're in the money, so to speak. I do want to talk about the real estate market too, and discuss a little bit more about the Liberals' plan for real estate and how that would impact you as potential homeowners, investors, first-time buyers, etc. And so this is the Canada Strong platform. That's the Liberals' platform, and how they're planning on being able to, create more affordable housing and make sure that values don't go too crazy. And one of the first things that they really want to do is they want to build more homes. And I find it interesting that they want to do this by being the developer. And they'll be building on Crown lands. They'll be doing a few other things like that. Makes me very, I don't know how to put this. I'm cautiously optimistic about how they could do this. And maybe I don't even want to use the word optimistic. I'm just very apprehensive to assume that the government will be able to act as a developer in a efficient manner. The concern, of course, and maybe I'm a little bit more, so to speak, right wing with my approach of, let the free market do its thing. But we've seen government try to get involved into things that are typically private businesses before. And it just is an inefficient way of doing things. And so will be interesting to see what happens and how they'll be able to act as a developer. But that is one of the plans for Carney's government, is to build more homes and act as a developer to do so. Here's an interesting one. They want to focus more on prefabricated and manufactured homes. And they actually are wanting to put $25 billion into loans. And they also use loans and grants, although I feel like most of this will be loans, not grants. But they're really going to be pushing a lot of money into this. They want to promote Canadian softwood and mass timber. And one of the things that I think is interesting here too is that not all banks like to finance prefabs. So I'm wondering if there's going to be a little bit more of a come around on this, because if the government is pushing this more, then I presume that the banks are going to be having to get a little bit more comfortable with lending on prefabricated homes. So be interesting to see. But prefab homes are faster and easier to put up. It's easier to train labor to be able to build these. And so it'll be interesting to see how that works. And yeah, any legislation in respect to prefabs, I have to imagine there would be. If the government wants to pour that much into prefabs, then there's going to have to be some changes in how they do this. One thing I'll note on the mortgage side, because I've run into this a few times, one challenge, and it can be either with the home buyer or if you're trying to get a construction loan, for instance, or on the business side, is on the prefab side of things. It's really tricky because normally when you're doing a home construction, you get a draw mortgage. And so the mortgage slowly increases over time as you reach milestones. So you get a draw at the land, usually about 50% of the land value. And then you get another draw once you hit the lockup stage, which is about 40% complete. And then about 65, 85, and 100% complete, generally speaking. Now, the problem with prefab is you've got all of the supplies and all of the stuff. You have to build it off site and construct it, get it ready, ship it to the site. So all of this cost involved with getting all of that prepared, the land still has just the land value at this moment. All the supplies show up on the doorstep, basically. And all you really can do is you can pour foundation, which is approximately 15% of the overall construction cost for a typical home build. So that's really only value that's poured into it as a fixture on the site. And then all of a sudden, boom, 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 in 1 week, the walls go up and everything's connected. And now all of a sudden the home is 85% complete in 1 week. Now the issue with that is, how do you fund it? So it's very difficult. And I've had a couple of companies reach out to me that are trying to figure out how to fund the prefab side. I've had customers reach out to me and say, hey, how do we get a construction mortgage for this? So I'm wondering if maybe one of the ways that the government could help out is by providing some kind of funding to kind of bridge that in order to make it easier, so that then there can be some financing that goes to the companies who are doing the prefabs. So at least they have an advance or whatnot that before it lands, because the bank doesn't want to lend on value that's not there. And they can't attach security or collateral to anything that's being built in a factory. So I'm interested to see how that all plays out, and wondering if there might be different, more unique ways of obtaining financing. And I've been thinking about this myself, and if anybody can come up with a great idea, it might be a really good opportunity actually moving forward to think about how to structure financing for prefabs, because that is going to be a more of a factor. Amy, you're asking, why don't lenders like prefabs? First of all, they just don't like things that are new. They're concerned about what the long-lasting impact of prefabricated homes might be. They're worried about the fact that if they're not, the joints aren't connected airtight, that water could get in, and water ingress issues are a major factor. Many of you remember the leaky condos from the 90s. And so they're just worried about the construction quality and how airtight these units are, in order to be able to reduce any weathering that these properties might encounter. Daria is asking, when are we going to hear Mark Carney's canceling GST in homes? Okay, that's coming up. That's coming up. We're getting ahead of the curve here. Don't worry, I have that on the slide. Developers. So another thing that Carney had suggested is that they're looking at putting about $10 billion into low-cost financing for developers. I assume this would probably be through CMHC. Hard to say exactly if this is going to go through CMHC, but I presume that this is probably going to be going through CMHC. Next up is lower development cost charges. So one of the things that I'm actually very curious how they're going to implement this, because this would be an interesting thing. So when you develop a property, you have to pay a DCC, it's called, with the city. So there's a cost involved with you entering in and getting your building permit or development permit. So they're looking at trying to reduce those charges in half, they said. That would be for all multifamily construction. And it sounds like what they're going to do is they still want to make the municipalities whole. So they want to create some kind of program where they can reduce it in half for builders, people that are doing construction, and then find a way of funneling some funding back to the municipalities to make sure that they're whole. So interesting to see. There's been a lot of upward movement on DCCs in the last 5 years, and so I'm interested to see what that comes down to. Here's an interesting one: 1970s tax. So They're looking at bringing back tax cuts that were available in the 70s to the early 80s. So I think the dates were actually 74 until 82 or 83 or something like that. And the tax was effectively something that allowed investors to write off depreciation. It's actually called the capital cost allowance for those of you that are accountants here. But they're allowing you to write off depreciation and other expenses against unrelated income. So what do I mean by unrelated income? That could mean that you have a business over here or a professional income that you're paying yourself every year. Let's say that you pay yourself $200,000 a year. And let's say that if you can write off the depreciation of the asset now, and it puts your multifamily property into a loss-making position, you can take that loss from this entity and write it off against your income here. So let's say that that loss is $80,000 for the multifamily property. They call it a MURB, M-U-R-B was the terminology. So they'd take that $80,000 and then they would write it off against the $200,000 personal income you have, which would reduce your taxable income to only $120,000. There's lots of opinions about that. Apparently, there's lots of ways that people were getting around it. It also all of a sudden made this investment more attractive just because of the tax reasons. And so I'm not 100% sure how all the dust will settle on this exactly, but long story short, they're looking at bringing this back for, again, multifamily properties and trying to make it a bit more attractive from a tax perspective. And then the last one is just less bureaucracy. They're trying to make it easier to convert existing units into affordable units, trying to make it so there's less zoning restrictions, and basically trying to aggregate everything so that you can work underneath one umbrella and say, okay, as long as they meet the criteria of this one entity, I can qualify to do what I want, as instead of working within a 13 set of rules. And what they mean by 13 sets of rules is that as you break it down into municipal level, provincial level, federal level, and all of these different things, they're trying to make it simple and easy to say, across Canada, you can just do this and it'll work. So I think they're trying to make it easier in order to offset that. One other item here that they're looking at is for new housing for first-time buyers, no GST if you're purchasing homes at or under $1 million. So that's the other big one. And of course, if you're looking at buying your own home, in particular for first-time buyer, and I don't know actually if it's only going to be for first-time buyers. There's some talk that it might actually be for all home buyers, regardless of whether you're a first-time home buyer or not, which would be really interesting. But they're looking at eliminating GST, which would be a big boon, especially for the pre-sale market, which has been hurting quite a bit lately. Any investors who have invested in pre-sales or have looked at that market probably have seen that the pre-sale market has been pretty tough lately. So what does all this mean? There's a line that I could draw here, and it's right between the 400 and the 500,000 or 400 and $600,000 or 405,000 unit mark. And if I look at this chart, so the Liberals are saying anyways that they want to build 500,000 homes a year. And if we look at this chart and see how many new residential units are constructed in the year, which is the yellow line, we can see that they have never gone over about 225,000 new homes constructed in any year. And the last year that we were, significantly over 200,000 would have been, maybe 2008. It looks like it's probably the last year that we eclipsed 200,000, or we're around that level. And then again, very recently in 2021 and into 2023. So it's not very common that we've even been eclipsing 200,000. So they want to more than double new housing construction with these. I applaud the ambitions to be able to do this. Some of the methodologies that they're looking at look fairly good. Also on the flip side, I'm still relatively skeptical that they can actually build the number of homes required, especially if you look at the red line, the population growth. And obviously, this has been curbed quite a bit recently. That red line is coming back down a fair bit. But the concern definitely is there's still a lot of people moving here. and a lot of a lot of people that need homes, and there's not a lot of new homes being constructed. So yeah, Gordon, what you're noticing obviously is just more people living in homes together, and so I do think that there is a factor here. A lot of immigrants are moving from heavily populated areas. If you're coming from India or China or perhaps Africa, etc., there's a lot of areas where people are accustomed to living in much smaller living quarters, and living here in one home with a number of families in it is not that uncommon. And so you don't need to see the number of new residential units being completely matching the population growth, but you do need to see that if the population growth is accelerating or going up, you do need to see that the number of new housing still has to increase. So high level, we're still in a situation where I think with all of these movements, I think a couple of takeaways for me would be, watch carefully on what kind of new tax laws come out. In particular, what I've been noticing, and this has been happening for a few years now, and I think this is going to continue, it seems like the government continues to make it harder for ma and pa investors to buy one-off residential units, and they continue to put more of an emphasis on multifamily residential properties. So CMHC financing has been easier. It has tightened up actually a little bit in the last few months, but it's still very, very good. And very, there's lots of incentives to doing multifamily financing through CMHC. We also are finding now a lot of these tax items that are coming up, they're promoting multifamily over anything else. And so I do think that if the Liberals are successful in building 500,000 homes a year, that's going to have a dampening effect on home values, which is not necessarily a bad thing. But I also am skeptical that they will actually be able to do that. This is not the first Liberal government that has said that. In fact, a Liberal government from very, very recent also said the same thing, and not much happened. So we'll see how this all transpires and plays out. But long story short, fixed rates likely starting to slowly tick up. Variable rates probably going down and then perhaps ticking up a little bit in the in a couple of years. Fixed versus variable, almost a break-even analysis right now. And then on real estate itself, short term, hard to say. I've found that the real estate market obviously was starting off with a bang earlier this year. I thought this year was going to be a really, really busy year. It's turned out to be an okay year, nothing too crazy. It really depends on what kind of product you're looking at. If you're looking at condos, then the market seems to be a bit softer than it is for detached, for instance. And depending on the market that you're in, if you're in Ontario, then the market's hurting a little bit harder than it is in BC. And if you're in Alberta, then the impact of the tariff situation might have a larger impact on employment there, which might have spin-off effects. So lots of things to watch here. And it's hard to say exactly what will happen, of course, but it does seem like, with all these competing factors, I think that at the end of the day, if you're an investor and you're looking at buying something, you're not in a position where you have to jump at the first thing you're looking at. A lot of my clients that are looking at buying their own home are in the same boat. They don't have to jump and buy the first thing that they see, which is not a bad thing. You actually can negotiate. You actually can try to get a better price on a property and try to work a seller down a little bit, which is not a bad time to be buying. Just to wrap things up, for anybody that is wanting to know if they can qualify and where the qualifications are, we've developed some software that allows us to underwrite and look at a number of different lenders with one set of inputs. It makes it really fast and easy for us to know what your options are with minimal documents from you. So if you ever want to learn more about that, then book a consult with us, and we're happy to touch base with you and give you some more feedback and do an evaluation of your portfolio, see if it makes sense to refinance and restructure anything that you own. And then, of course, many of you have already have a copy of my book. But if you don't have a copy of my book, just reach out, let us know what your mailing address is, and we'll be happy to pop a copy of my book, Rockstar Real Estate Investing, in the mail. And other than that, feel free to reach out if you have any questions. I will answer some questions that have been posted. I think there are a few in the Q&A here, so I'll open that up. Okay, so questions. Gunther asks, if you're in your estimation, when do you think the Vancouver real estate market will recover regarding timing on selling versus holding on a bit longer? Good question. So I think this depends on the asset that you're in. So I have a lot of clients that are buying pre-sale condos right now, and my advice to them is that you might need to be hanging on to that property for perhaps a year. So I'm expecting that, especially in the condo market, it may take a year, perhaps even a little bit longer before that market recovers. If you're in detached, I don't think that the market's going to be that soft for that long. I think that you could see that by this fall, or even by summer, that the market has recovered a fair bit for detached. But I think that for condos, especially if you're buying in a building where there's a lot of pre-sales in it, especially investors, you might be hanging on to that for a year or two. And one of the things that we've been doing is just doing a quick math formula to look at, hey, should you try to just offload that condo at whatever price you can get it for, or just hold it for a year or two, knowing that you're going to be running it at a loss? And as an example, if you're buying a $500,000 condo and you might be $1,000 a month in negative, well, that's 12 grand per year. So if you have to hold it for 1 or 2 years, then you lose 12 to 24 grand in negative cash flow. Versus if you bought the condo for 500 grand, or that's what you're paying for it, and in order to offload it immediately, it's not unrealistic that you might have to take a 10% haircut on the price, meaning that you have to drop it from 500 to 450, meaning you take a 50 grand loss. So, some people can't afford that $1,000 a month negative, and they rather just take the hit now. But I think the math is generally in people's favor to just hold on to the property, wait for a better time to sell. Generally, you win in real estate by not having to be forced to sell your property in an opportune time. So my advice would be to try to hold on to it for longer if you can. Awesome. Ron asks, the sweet spot, or he's not asking actually, mentioning the sweet spot likely seems to be lock-in for 5-year fixed, as I'm in variable now. So that very well could be the way to go, is just to lock it in and forget about it. I do find that in the last couple of years, investors have been a bit more wary of things and are looking at taking some risk or chips off the table, so to speak. If you're in that position where you just don't really want to be, left with additional risk, then it does make sense to maybe consider locking it in. Just note that the penalty to break that mortgage could be a lot more expensive if you do so. So just bear that in mind. Okay, well, that was all the questions in the Q&A. And I think we've answered everything that came up in the chat as well. Any other questions? Anything else? You guys are taking it easy on me. I figured doing something with politics involved was going to result in a lot of questions that I couldn't answer. So, yeah. Okay, well, I'll wrap up from here. It was great to see a lot of you. Thanks for coming out today. If you have any other further questions, just reach out, let me know. And looking forward to seeing all of you in the future. Thanks so much, everyone. Bye now.